There's a financial crisis happening right now that mainstream media is barely covering, not because it is small, because it is enormous, and because the institutions at its center have spent a decade marketing themselves as safe, stable, and sophisticated. They are none of those things right now. In the first quarter of 2026, 7 of the largest private credit funds on the planet simultaneously capped investor withdrawals. 7. At the same time, in the same quarter, the names involved are not obscure. They are the most powerful alternative asset managers in the world. Blackstone, BlackRock, Apollo, Ares, Blue Owl, Morgan Stanley, Cliffwater. Together, these 7 firms collectively received over $10 billion in redemption requests from investors who wanted their money back, and they agreed to honor only about 70% of those requests. The rest? Trapped, frozen, gone for now. Blue Owl went further than anyone. They stopped honoring withdrawals altogether and replaced redemption requests with IOUs. Not partial payments, not temporary delays. Formal IOUs, a written acknowledgement that the money cannot currently be returned. BlackRock's $26 billion HPS corporate lending fund received $1.2 billion in withdrawal requests. It paid out roughly half. Blackstone's flagship private credit fund was hit with $3.8 billion in withdrawal demand, representing 7.9% of its assets. The firm raised its withdrawal cap and then, in an extraordinary move, injected $400 million of its own capital, taken from senior executives and the firm itself, just to cover investor demands for liquidity. Think about what that means. One of the most powerful financial institutions in the world had to reach into its own pocket to give investors back their own money. Ares' Strategic Income Fund faced 11.6% of its assets in redemption requests. It honored only the mandatory minimum. Cliffwater's $33 billion fund saw 14% of its investors demand their money back. 14%. In a single quarter. And here is what makes all of this so critically important for every investor watching this right now. The private credit market was sold to retail investors, to wealthy individuals, to family offices, and to pension funds as a stable, high-yield alternative to public markets. It was marketed as a place where your money was safe from the daily volatility of stocks and bonds. It was promoted as the smart money's secret. Well, the secret just became a crisis, and the people who trusted the story are discovering that the liquidity they were promised does not exist, not when everyone wants it at the same time, not when the tide goes out. As Warren Buffett famously observed, you never know who has been swimming naked until the tide goes out. The tide is going out right now in private credit. And what it is revealing is a shadow financial system worth $1.7 trillion that has never been properly stress tested, never been fully regulated, and never been forced to confront the fundamental lie at its center. That lie is this: you cannot offer regular liquidity on inherently illiquid assets, not without a crisis. And the crisis is here. Before we go deeper, let me give you the 4-stage framework that makes this story not just urgent, but historically inevitable. Because this is not a random event, it is a mechanism. And the mechanism has repeated before. Stage 1 is the shadow expansion. This is where non-bank lenders, meaning private equity firms, hedge funds, and alternative asset managers, step into the gap left by tighter bank regulations and begin providing loans directly to companies. The market grows explosively. The returns look spectacular compared to public bonds. Investors flood in, standards quietly deteriorate. Stage 2 is the liquidity mirage. This is where semi-liquid fund structures are invented and marketed to retail investors. The story is compelling. Get the high returns of institutional private lending, but with quarterly redemption windows. The problem is that the underlying loans are inherently illiquid. They cannot be sold quickly. The fund promises something the underlying assets cannot deliver. As long as nobody wants their money simultaneously, the illusion holds perfectly. Stage 3 is the trigger event. Something breaks the illusion. A rate shock, a default wave, a technological disruption. External pressure that causes investors to doubt the underlying asset values. Redemption requests spike. The fund gates withdrawals to prevent a fire sale. The gate is not just a liquidity management tool, it is a public announcement that the liquidity promise was never real. Stage 4 is the contagion and repricing. The gate at one fund triggers fear at similar funds. Investors who had not previously thought about exiting suddenly think about it. Redemption requests cascade. Credit ratings get scrutinized. Valuations that were marked to model rather than to market get forced into daylight. And the true losses, hidden behind accounting conventions and opaque reporting for years, finally surface. That is the 4-stage framework. Now let me show you exactly how this has played out before. 3 documented case studies, each one more revealing than the last, each one showing the same mechanism in motion. Go back to the savings and loan crisis of the 1980s. This is the first major modern example of what happens when non-bank financial institutions make promises they cannot keep in a changed rate environment. The savings and loan associations, commonly known as thrifts, were institutions that took short-term deposits from ordinary Americans and lent them out in long-term fixed-rate mortgages. This is a classic liquidity mismatch. Short-term liabilities funding long-term assets. When the Federal Reserve raised interest rates to combat inflation in the early 1980s under Paul Volcker, the cost of the short-term deposits that thrifts paid to their depositors shot up dramatically. But the long-term mortgages on their books were earning fixed rates that were far below the new market rate. The institutions were technically insolvent. Their assets were worth less than their liabilities. But for years, accounting rules allowed them to keep the loans on the books at face value rather than at market value. The problem was hidden, masked, disguised by the same accounting convention that now dominates the private credit market, mark-to-model rather than mark-to-market. The illusion of stability, created not by actual stability but by the absence of honest pricing. When the reality finally forced itself into the open, 1,043 savings and loan associations failed between 1986 and 1995. The total cost to taxpayers of the bailout reached $132 billion. Ordinary Americans lost billions in deposits that were not fully insured. The failure was not caused by fraud alone, although there was plenty of it. It was caused by a structural mismatch between asset illiquidity and liability liquidity, dressed up in accounting conventions that made the problem invisible until it was catastrophic. Sound familiar? Check. Verified. Undeniable. Now move forward to the summer of 2007. Two Bear Stearns hedge funds, the High-Grade Structured Credit Strategies Fund and the High-Grade Structured Credit Strategies Enhanced Leverage Fund, collapse. At the time, most financial commentators called it an isolated event, contained, specific, not systemic. Bear Stearns' own risk management team assured investors that the firm's exposure was minimal. The funds had been investing in collateralized debt obligations backed by subprime mortgages. The underlying loans were marked to model because there was no active market for these complex instruments. Nobody truly knew what they were worth, until someone needed to sell them. In June of 2007, as investors began requesting redemptions, Bear Stearns tried to sell some of the underlying assets to raise cash. The prices they received were dramatically lower than the model valuations they had been reporting. Not slightly lower, catastrophically lower. The discrepancy between model value and market value was so severe that the funds effectively had no equity. They were worthless. The realization cascaded through the financial system. If these instruments were worth far less than their model valuation suggested, what else was being valued incorrectly? The answer was everything. The entire 2008 financial crisis, $11 trillion in household wealth destroyed, 8 million jobs lost, was the downstream consequence of the discovery that model valuations in an opaque, illiquid asset class were fiction. The same fiction is now embedded in $1.7 trillion of private credit assets. And the same discovery process is beginning right now. Check. Verified. Undeniable. One more. And this one is even closer in structure to what is happening today. The commercial real estate collapse of 2023 and 2024. Non-traded real estate investment trusts, commonly called non-traded REITs, had spent years raising money from retail investors by offering higher yields than publicly traded alternatives. They marketed themselves as stable income generators, largely insulated from the day-to-day volatility of public markets. Blackstone's Brait was the flagship example. It grew to over $68 billion in assets by late 2022. Then interest rates rose, commercial real estate values fell, and investors began requesting redemptions. Blackstone gated withdrawals in November of 2022. The gate stayed in place for most of 2023. The mechanism was identical to what is happening now in private credit. Semi-liquid fund promises, regular redemptions. Underlying assets are liquid. Rates rise, asset values fall, investors get nervous, redemption requests spike, gates go up. The liquidity promise evaporates. The structure breaks not because of fraud, because of physics. The physics of illiquid assets inside liquid promise wrappers. That same physics is destroying the private credit market right now, at a scale that dwarfs anything we have seen in this asset class before. Check. Verified. Undeniable. Now let us apply this framework to what is happening in 2026 with surgical precision, because the details matter, and every detail is more alarming than the last. The private credit market grew from roughly $500 billion a decade ago to $1.7 trillion today, according to Federal Reserve research cited by CNBC. Some estimates that include all forms of non-bank lending put the broader private credit universe as high as $2 trillion for leveraged direct lending alone, as noted in Jamie Dimon's April 2026 letter to shareholders. This explosive growth was fueled entirely by the artificially low interest rate environment of the post-2008 era. When the Federal Reserve held rates near zero, institutional investors were starved for yield. Private credit funds promised yields of 8, 10, 12% or more through direct loans to middle market companies. The returns looked extraordinary compared to Treasury bonds yielding 1 or 2%. Capital flooded in from pension funds, insurance companies, university endowments, sovereign wealth funds, and increasingly from wealthy retail investors through semi-liquid structures called interval funds and non-traded business development companies. These semi-liquid vehicles were the brilliant innovation that democratized private credit. They allowed ordinary wealthy individuals, not just billion-dollar institutions, to access what had previously been an exclusive institutional market. And in doing so, they embedded a structural time bomb inside the asset class. The bomb is the liquidity mismatch. The underlying assets are loans to private companies. These loans are typically 5 to 7 year term instruments. They cannot be sold quickly in secondary markets, particularly during stress, but the fund that holds them promises investors quarterly redemption windows. As long as inflows exceed outflows, the promise is fulfilled easily. New investor money pays out existing investors who want to leave. This is not fundamentally different from a Ponzi scheme and its mechanics during periods of stress. It works perfectly in a world of expanding capital and rising asset values. It breaks catastrophically the moment confidence falters. Confidence began faltering in late 2025 for two simultaneous reasons. The first was the rate environment. The Federal Reserve held rates at 3.5 to 3.75% throughout the first quarter of 2026. That means private credit borrowers, the middle market companies taking out loans from these funds, have been paying 8, 9, 10% floating rates for years. Their interest coverage ratios, the measure of how easily a company can pay its interest from operating earnings, collapsed to 1.6 times by early 2026. That is a precarious number. It means the average private credit borrower has almost no cushion. Any revenue shortfall, any cost increase, any economic headwind, and they cannot make their interest payment. The private credit default rate hit 5.8% through January of 2026. That is the highest reading since Fitch's private credit default index launched. Morgan Stanley now forecasts that rate will climb to 8%, representing more than triple the historical average of 2 to 2.5%. UBS has issued an even darker forecast. Under a scenario of severe AI disruption to software borrowers, UBS warns default rates could reach 13%. Let that number sink in. 13% of all private credit loans defaulting. The second reason confidence faltered is artificial intelligence. This is the part of the story that is genuinely unique to this moment in financial history and that most analysts are still struggling to fully price. 26% of all private credit direct lending is concentrated in software companies, according to Morgan Stanley. These are not the software giants like Microsoft or Salesforce. These are the thousands of mid-sized software-as-a-service companies that grew explosively during the low-rate era of 2020 to 2022. They raised enormous amounts of debt from private credit funds to fund acquisitions and expansion, promising to repay it from the recurring subscription revenue their software businesses generated. Then artificial intelligence arrived. The business models underlying these loans began to erode. If AI can do what 10 software subscriptions previously required, the subscription revenue that secured the loans begins to disappear. The enterprise value of these borrowers, which was the collateral backing the loans, starts evaporating. Fitch Ratings stated explicitly on March 10th of 2026 that asset-light businesses where value is driven by intangibles, such as software, face higher disruption risk as AI-enabled substitutes emerge. They noted these sectors could see intensified competition and pressure on pricing and margins. The collateral is degrading. And 50% of software sector borrowers in private credit are rated B- or lower, according to Morgan Stanley. That is the lowest rung of the credit rating spectrum. These are companies that were already financially fragile before AI began dismantling their revenue models. The combination of high rates and AI disruption hitting simultaneously is generating what the industry is calling a software-driven default surge. And the private credit funds most exposed to software lending are the ones in the deepest trouble. Blue Owl Capital, which is heavily concentrated in software and technology lending, has seen its stock price fall 41% year to date, as of mid-March 2026. Blackstone's private credit fund, BCRED, posted its first monthly loss in 3 years in February, partly from marking down loans, including debt linked to software company Medallia. Blue Owl went further. It sold $1.4 billion in loan assets in February just to raise enough cash to partially meet redemption requests, and then it issued IOUs for the rest. Now here is where the story gets structurally dangerous for the broader financial system, because private credit does not exist in isolation. It is deeply interconnected with the regulated banking sector in ways that are not fully visible even to the regulators themselves. Banks that lent money to private credit funds to amplify their returns through leverage are exposed. Insurance companies that allocated billions to private credit for their liability portfolios are exposed. Pension funds that used private credit to boost returns above their liability hurdle rates are exposed. And regional banks that partnered with private credit managers for loan origination, keeping a portion of loans on their own books while selling the rest to private funds, face a dual exposure if the loans deteriorate and the private credit markets simultaneously freeze up. Jamie Dimon, chief executive of JP Chase, the most powerful banker in the world, issued what has become known as the cockroach warning about this market. In October of 2025, after the high-profile collapses of subprime auto lender Tricolor Holdings and auto parts supplier First Brands Group, both of which were heavily financed by private credit, Dimon said on a conference call, "When you see one cockroach, there are probably more. Everyone should be forewarned on this." He was not speaking metaphorically. He was speaking from inside knowledge. First Brands was not just a business failure. In a court filing, newly appointed directors of First Brands revealed as much as $2.3 billion in unpaid loans. They described it as off-balance sheet financing because the company borrowed money without officially disclosing it on the books. The Department of Justice has reportedly opened a criminal investigation. JP Morgan itself suffered $170 million in losses linked to the Tricolor bankruptcy, despite its so-called fortress balance sheet. And Dimon's warning was that these were not isolated incidents. They were the first cockroaches, the ones that become visible before the lights come on and reveal how many more are hiding in the walls. In his annual April 2026 letter to shareholders, Dimon returned to the theme. He wrote that credit quality has already begun to erode. He acknowledged that actual losses in leveraged lending are outpacing what current conditions would ordinarily suggest. He warned that lending standards have been modestly weakening across the board, and he identified the deepest structural flaw. Because loan valuations in private credit lack the rigor and transparency of public markets, investor exits can begin well in advance of any real deterioration in credit performance. Investors do not need to wait for a loan to actually default to want their money back. They just need to doubt the marks. And the doubt has already arrived. The Department of Justice has issued a public warning about creative marks and divergent valuation practices in private portfolios. The Securities and Exchange Commission is investigating Egan-Jones ratings in a probe that has placed the integrity of private credit ratings under a spotlight. A BlackRock private credit collateralized loan obligation failed its over-collateralization test, a structural trigger that forced the manager to waive fees in a clear stress signal. Jeffrey Gundlach, chief executive of Double Line Capital and one of the most respected fixed income investors in the world, has repeatedly warned that private credit may be the top candidate to start the next financial crisis. He has specifically called semi-liquid private credit exchange traded funds the ultimate sin, arguing that the structural mismatch between daily liquidity promises and illiquid underlying assets is a disaster waiting for a trigger. The trigger has now arrived. 7 of the largest private credit managers in the world have simultaneously gated withdrawals. Over $10 billion in redemption requests were only partially honored. Blue Owl issued IOUs. Blackstone injected $400 million of its own capital. The private credit default rate is at its highest level ever recorded. Morgan Stanley is forecasting it goes to 8%. UBS is warning it could hit 13%. Bad PIC, meaning payment in kind loans where companies pay interest with more debt instead of cash, meaning they cannot actually afford to pay interest in cash, reached 6.4% of total private debt volume in the first quarter of 2026, according to KBRA and Fitch Ratings. Bad PIC is how the market masks insolvency before it becomes default. It is the accounting convention that lets a dying company pretend it is still alive. And it is running at 6.4% of the entire market right now. The shadow crash is not coming, it is in progress. Now let us destroy the 3 myths that private credit insiders are going to use to calm you down when you start asking questions about this. Myth 1 is that this is just a retail investor problem in semi-liquid funds. The reality is that the stress began in retail semi-liquid vehicles, but is already spreading. Bloomberg data from early 2026 shows some smaller issuers in the sector recording 10.9% default rates. These are not retail fund issues. These are fundamental credit quality problems in the underlying loan portfolios. The contamination between retail semi-liquid funds and institutional direct lending vehicles is happening through shared portfolio construction, shared borrower exposure, and shared market sentiment. When Morgan Stanley forecasts 8% defaults in direct lending, they are not talking about the retail wrapper. They are talking about the underlying loans themselves. Myth 2 is that the largest managers are fine because they have strong fundamentals. Blackstone had to inject $400 million of its own capital into a fund to cover redemptions. Ares capped withdrawals after 11.6% of its fund tried to leave. Apollo officially gated its $25 billion Apollo Debt Solutions vehicle. These are not peripheral players. These are the largest alternative asset managers in the world, and they are all simultaneously showing the same structural fragility. When the biggest firms in an industry are simultaneously injecting their own capital and issuing IOUs, there is no version of this story where the industry is fundamentally fine. Myth 3 is that this cannot spread to the broader financial system because private credit is too small to be systemic. Jamie Dimon himself estimated the leveraged private credit market at $1.8 trillion in his April 2026 shareholder letter. He suggested at that size, it probably does not present a systemic risk. But here is what that framing misses. The contagion risk from private credit is not primarily about direct losses in the funds themselves. It is about the second-order effects. The insurance companies that allocated 30% of their portfolios to private credit face a capital shortfall if valuations are forced to reflect reality. The pension funds that counted on private credit returns to meet their liability obligations face a funding gap. The regional banks that co-originated loans with private credit managers face write-downs on their shared exposures. The broader credit market sentiment that looks at gated withdrawals and frozen redemptions in a $1.7 trillion asset class and starts asking whether other seemingly liquid markets are also hiding illiquidity. Credit contagion does not spread through direct exposure alone. It spreads through confidence. And confidence in the private credit market is now broken. So what do you actually do? Because understanding the problem without a framework for action is just anxiety dressed up as analysis. Here's how you think about the shadow crash right now. First, if you have any exposure to semi-liquid private credit vehicles, interval funds, non-traded BDCs, or evergreen credit funds, you need to understand your redemption terms immediately. Not next quarter, now. Because the queue for getting out of these vehicles is lengthening with every passing week. The investors who recognized the structural problem earliest and submitted redemption requests first are getting paid first. The investors who wait until this becomes headline news everywhere are going to find themselves at the back of a very long line. Second, understand that the stock prices of the major alternative asset managers are forward-looking signals about the health of their underlying portfolios. Blue Owl Capital down 41% year to date. Blackstone down nearly 31% year to date. These are not random market fluctuations. They are the public market sending a message about what is happening inside these private, opaque portfolios. The public equity market is a leading indicator for private credit stress. It is showing you the problem before the quarterly NAV reports acknowledge it. Third, understand that payment-in-kind loans are the canary in the coal mine. When you see PIK ratios rising in the quarterly filings of business development companies, which are the publicly traded vehicles that give you the most transparency into private credit portfolios, it means borrowers cannot afford to pay cash interest. If PIK continues to rise above 10% of total investment income in any BDC you are monitoring, you are looking at a portfolio where hard defaults are approaching. Watch those numbers in the next set of earnings reports. Fourth, understand the AI disruption thesis is real and structural, not temporary. 26% of all private credit direct lending is exposed to software companies whose business models are being eroded by artificial intelligence. This is not a cyclical problem that resolves when the economy recovers. It is a structural destruction of the enterprise value underpinning the collateral backing those loans. Morgan Stanley says 8% defaults. UBS says 13 under a severe scenario. The loans maturing in 2027 and 2028 for software companies represent significant refinancing risk in a world where AI has degraded their revenue models. 11% of software loans mature by year-end 2027, another 20% in 2028. Those maturities are not abstractions. They are countdown clocks. Fifth, watch what the regulators do. The Financial Stability Oversight Council voted in late March of 2026 to publish new guidance on non-bank financial company designations. The SEC is actively investigating rating agency conflicts of interest in private credit. The DOJ has warned about creative marks and valuation divergences. When multiple federal agencies simultaneously begin probing the same asset class, the regulatory reckoning is coming. And when regulators force private credit valuations to reflect reality rather than models, the marks are going to move down. Sixth, the broader lesson is about liquidity. In every financial crisis in history, the investors who survived and positioned well were not necessarily the smartest. They were the most liquid. They maintained the ability to stay solvent, while the forced selling of illiquid assets created genuine value opportunities for patient capital. Right now, in the shadow crash, the most important thing you can do is understand which of your investments are genuinely liquid and which ones have promised you liquidity they cannot deliver. The private credit market has spent a decade promising retail investors liquid access to illiquid assets. That promise is breaking right now, in real time. in full public view, with IOUs and redemption gates and capital injections from panicking executives. Here's the summary of everything you now know about the shadow crash. The private credit market grew from $500 billion to $1.7 trillion in a decade by offering yields that traditional fixed income could not match, and by making a promise it was structurally incapable of keeping. That promise was that illiquid loans could be wrapped in the semi-liquid fund structures and made accessible to investors with quarterly redemption windows. 7 of the world's largest alternative asset managers simultaneously discovered in the first quarter of 2026 that this promise is mathematically impossible when everyone wants their money at the same time. Blue Owl issued IOUs. Blackstone injected $400 million of its own capital. BlackRock honored only half of withdrawal requests. Ares, Apollo, Morgan Stanley, and Cliffwater all capped redemptions simultaneously. Over $10 billion in withdrawal requests were only partially honored. The private credit default rate is at its highest ever recorded level of 5.8%, and Morgan Stanley forecasts it goes to 8%. 26% of all direct lending sits in software companies whose enterprise value is being destroyed by artificial intelligence. Bad PAIC loans, the early warning signal of approaching default, reached 6.4% of total private debt volume in the first quarter. Jamie Dimon warned the world about cockroaches in this market in October of 2025. The DOJ and SEC are actively investigating. The pattern is identical to every shadow banking crisis in history, the savings and loan crisis, the Bear Stearns funds of 2007, the non-traded rate gate of 2022. The same mechanism, the same stages, the same denial, the same eventual reckoning. The shadow crash is not a future possibility. It is happening now, in the dark, behind closed doors, with IOUs replacing redemption checks and injected capital replacing genuine liquidity. The people who understand this pattern and act accordingly will look back on this moment as one of the most important financial inflection points in a decade. Everyone else will wonder why nobody warned them. If this video gave you something that your financial advisor is not telling you, something that the trillion-dollar alternative asset industry does not want you to understand, hit subscribe right now. Because this channel exists for exactly these moments. The moments when the signal is clear, the pattern is documented, and the window to act intelligently is still open before this becomes the headline that everyone already knew was coming. Watch the next video on this channel. The shadow crash is entering a new phase, and you need to understand what that next phase looks like before it arrives. Subscribe. Share this with one person who has money in these markets, because the lights are about to come on, and everyone who waits to see how many cockroaches there are before taking action will wish they had moved sooner.